Module 2, Finance Fundamentals for Non-Financiers. Here's a scene you'll recognize. You're in a meeting and a project you believe in deeply, a climate-resilient road, say, gets described as not bankable, with an IRR below the cost of capital, so it needs de-risking before it's investable. Everyone nods. The project stalls. And you're left thinking, those were English words, but I couldn't tell you what a single one of them meant. This module fixes that permanently. By the end, you'll understand three things. First, the time value of money, and the two numbers built on it that finance people live by, NPV and IRR. Second, the relationship between risk and return and the idea of a cost of capital. And third, why climate projects and adaptation projects in developing countries most of all tend to look weak when you run them through this machinery. This is the finance backbone of the whole course, so we'll take it slowly and concretely. Let's begin with the single most important idea in all of finance, the time value of money. It's this. $1 today is worth more than $1 a year from now. Not because of inflation, though that's part of it, but for a deeper reason. $1 today can be put to work. You could invest it, lend it, earn something on it, so that in a year you'd have more than $1. So $1 promised to you next year is worth less to you right now than $1 in your hand today. Money has a time value. Let me make that concrete. Suppose I offer you $1,000, but you have to wait a year to receive it. What's that promise worth to you today? Well, if you could reliably earn, say, 10% a year on your money, then you'd only need to set aside about $909 today to have $1,000 in a year. So that future $1,000 is worth about $909 to you now. We say we've discounted it back to the present. That shrinking of future money into today's terms is called discounting, and it is the heartbeat of finance. The rate you use to shrink it, the 10% in my example, is called the discount rate. And here's the key intuition. A higher discount rate shrinks future money more aggressively. If you use a big discount rate, money arriving far in the future is squeezed down to almost nothing in today's terms. Remember that, because it's about to explain why long-term climate projects struggle. Wait, who decides what the discount rate is? Is it just an opinion? It's a judgment, but not an arbitrary one. The discount rate reflects two things: how much return you could earn elsewhere and how risky this particular thing is. If safe investments pay you 8%, you won't accept less than 8% here, so 8% is your floor. Then, if this project is risky, you demand extra on top as compensation for the risk. Maybe you insist on 15%. So the discount rate is really the return you require to part with your money and put it here instead of somewhere else. And this is the quiet villain of our story, because projects in developing countries get assigned high discount rates, precisely because they're seen as risky, and high discount rates crush the value of anything with long-term payoffs. We'll come back to that. Just plant the flag. Now that you have discounting, two famous numbers fall right out of it. The first is NPV, net present value. Here's the whole idea in plain words. A project has money going out, the upfront cost, and money coming in, the returns over the years. To judge it, you take every one of those future inflows, discount each one back to today's value, add them all up, and then subtract what you spent up front. What's left is the net present value, the value the project creates, expressed in today's money. The rule is beautifully simple. If the NPV is positive, the project creates value, it's worth doing. If it's negative, it destroys value, you'd be better off putting your money elsewhere. That's it. A solar plant costs, say, $10 million up front, and its discounted future electricity sales add up to $12 million in today's terms. Net present value, positive $2 million. Good project. Change the discount rate from 10% to 18% though, and those future sales might shrink to $8 million in today's terms, and suddenly the NPV is negative $2 million. Same plant, same electricity, different verdict, purely because the money was judged riskier. Sit with that. The physics didn't change. The finance did. The second number is IRR, the internal rate of return. Think of it this way. We just saw that a project's NPV depends on the discount rate you use. IRR asks the question from the other direction. What discount rate would make this project's NPV exactly zero, the break-even rate? That break-even rate is the IRR, and you can think of it as the project's own built-in yearly rate of return. If a project has an IRR of 12%, it's effectively earning you 12% a year on your money. And now those meeting words start to click into place. People compare a project's IRR to their cost of capital. So what's cost of capital? It's simply what the money costs the person providing it. If a bank borrows at 6% to lend to you, 6% is part of its cost of capital. If an investor could earn 15% elsewhere, 15% is their cost of capital, their hurdle. The rule investors use is this. If the project's IRR is above my cost of capital, I make money, do it. If the IRR is below my cost of capital, I lose money, walk away. So when someone says the IRR is below the cost of capital, they mean the project earns less than the money costs. It's underwater. That's the whole sentence decoded. Let me make this vivid with a comparison you should carry around in your head, because it captures the whole injustice in a single picture. Take one identical solar project, the same panels, the same design. Build it in a wealthy European country, and the developer might raise money at a cost of capital of around 4 or 5%, because everything about the setting feels safe and familiar to investors. Now build that exact same project in a developing country, and the cost of capital can easily be 15% or more. Same panels, same sunshine, often more of it, but the money costs 3 or 4 times as much. And because, as we've seen, a higher cost of capital means a higher discount rate, which crushes long-term value, the developing country project can flip from clearly worthwhile to clearly unviable, purely on the price of money. The single biggest reason clean energy is more expensive in your part of the world is not the technology. It's the cost of capital. Hold that sentence, because it reframes a great deal of what looks like a technical problem into what it really is, a financing problem. Let me now put the biggest idea of the module in front of you, risk and return, because it governs everything else. The core law of finance is that risk and return are linked. The riskier something is, the higher the return investors demand before they'll touch it. Think of lending money to a rock-solid government versus lending to a brand-new startup in an unfamiliar country. You'll lend to the government for a small return because you're confident of repayment. You'll only lend to the startup if the potential return is much higher, to compensate you for the real chance of losing everything. That demand for extra return in exchange for taking on extra risk is called a risk premium, and it is charged, mercilessly, to developing countries. This is why the same solar project can be perfectly bankable in Germany and unbuildable in Lao PDR. Not because the sun is different, because investors attach a higher risk premium and therefore a higher required return, a higher discount rate, to the developing country version. Everything gets more expensive, and long-dated benefits get discounted into oblivion. Let me name the specific risks that pile into that premium, because they're not mysterious and they're worth being able to list. There's currency risk, the danger that the local currency loses value, so that revenues earned in kip or dong are worth far less when converted back to the dollars or euros an outside investor cares about. There's political and regulatory risk, the danger that a government changes a tariff, a subsidy, or a permit halfway through a 20-year project. There's what's called offtake risk, the danger that the buyer, often a state electricity utility, can't reliably pay its bills. And there's simple unfamiliarity, the danger the investor imagines because they've never worked in your country and don't know how to judge it. Each of those adds a slice to the required return. Understanding this list is powerful because it tells you exactly where the tools we meet later, guarantees, insurance, blended finance, will need to bite. De-risking isn't vague. It's the targeted removal of specific items from this list. Let me now define the 2 words that open this module, because you're finally equipped to really understand them. Bankable. A project is bankable when a bank or investor looks at it and concludes, yes, this will generate enough reliable return to justify the money and the risk, so we'll fund it. Bankable means fundable on commercial terms. It's not a statement about whether the project is good for the world. It's a statement about whether the numbers work for the financier. A brilliant mangrove restoration can be completely unbankable because it produces no cash to repay anyone, even as it protects a whole coastline. De-risking. Since we've seen that high perceived risk is what kills projects, de-risking simply means taking deliberate steps to reduce that risk, or to shift it off the private investor's shoulders onto someone more willing to bear it, usually a government or a development bank. If a donor promises to cover the first losses if the project fails, The private investors' risk just dropped, so their required return drops, so the project's numbers suddenly work. De-risking is the art of making a good-for-the-world project also look good on the financier's spreadsheet. A huge amount of what climate finance institutions actually do, day to day, is de-risking. Modules 8 and 9 are entirely about the tools for it. This all sounds like the finance is just being unfair to poor countries. Is the high discount rate wrong, or is it capturing something real? It's capturing something real, and that's what makes it so hard. Currencies in developing countries really can lose value, which genuinely hurts a foreign investor's returns. Rules and governments really do change. Projects really do fail more often where institutions are newer. So the risk premium isn't pure prejudice, some of it is rational pricing of real risks. But, and this is the important but, it's often overstated. Investors who don't know a country well tend to lump it in with its neighbors and assume the worst, charging more risk premium than the actual track record justifies. So part of the job of climate finance, and of you as a practitioner, is to correct that overpricing, to show the real risk is lower than assumed, and to bring in institutions that can absorb the risk that genuinely remains. It's both a real problem and an exaggerated one at the same time. Now let me tie this directly to why climate projects specifically struggle on these terms. There are 3 reasons, and you now have the tools to feel each one. The first is long time horizons. Climate projects tend to pay back slowly, over decades, but discounting punishes the distant future, and a high developing country discount rate punishes it savagely. Benefits that arrive in year 20 are worth almost nothing in today's NPV once you discount them at 18%. So the very projects that matter most for the long term look weakest in the math. The second is high upfront costs. Renewables and resilient infrastructure are capital heavy, big spend now, savings later. A solar plant once built has almost free fuel, the sun, but you pay for nearly the whole thing on day one. A diesel generator is the reverse, cheap to install, expensive to feed forever. Finance, discounting the future, has a quiet bias toward the thing that's cheap today even when it's ruinous over time, which is exactly backwards for the climate. That front-loaded cost, discounted against back-loaded benefits, strains the NPV of the very projects we most need. The third, and this is the killer for adaptation, is weak or absent revenue. Run a sea-wall through this machinery, and you get no inflows to discount at all, just cost. Its NPV, in pure financial terms, is deeply negative, even though its value to society is enormous. The machinery simply cannot see value that doesn't arrive as cash. That blind spot is why adaptation needs grants, and why we can't leave it to markets. I want to name that blind spot precisely, because as a climate expert, it's your strongest argument. There's a difference between financial return and economic return. Financial return is the cash that lands in the investor's account, which is all the NPV and IRR machinery can see. Economic return is the total value to society, the avoided flood damage, the lives not lost, the harvests protected, the health improved. A seawall can have a magnificent economic return, saving $10 of damage for every dollar spent, while having a financial return of exactly 0, because none of that saved damage arrives as revenue anyone can collect. The tragedy of pure finance is that it optimizes for the first number and is blind to the second. This is not a flaw you can argue away with a better spreadsheet. It's structural. And it's the deepest reason public money, grants above all, must exist to fund the enormous economic value that the financial machinery simply cannot register. When you make the case for an adaptation project, you're really insisting that people look at the number the market refuses to see. So, to bring it together, money has a time value, so we discount future money into today's terms, and the discount rate we choose reflects how much return we could earn elsewhere plus how risky the thing is. From discounting we get NPV, the value a project creates in today's money, positive is good, and IRR, the project's own break-even rate of return, which investors compare to their cost of capital. Risk and return are welded together, and developing countries get charged a risk premium that inflates their discount rates and crushes long-term projects. Bankable means the numbers work for a financier, and de-risking means shifting risk to make them work. And climate projects struggle on all of this because their benefits come late, their costs come early, and for adaptation especially, no cash comes in at all. Now that you can see why so many climate projects can't stand on commercial terms alone, the natural next question is, what other kinds of money exist, and how do they fill the gap? That's the spectrum of money, and it's Module 3.